But we've got you look at it like two categories. We've got people that are one, they're obviously interested in real estate and they want to generate passive income, but they're not an active real estate professional. They're typically a professional outside of real estate that's working and then taking earned dollars and putting it into passive income. And then we have the other segment that's active real estate folks that normally have their own investments as well. So they're doing their own investments. They're actively buying and selling stuff, and then they can kind of use more of the active depreciation that's coming out of our deals that they're receiving on their investment side. So it's really those two types of people. We've got a lot of individuals too that have either sold deals or rolled 1031s, and instead of being that active owner operator, they've rolled into our deals. And then we've also had them where they've rolled out and they've bought their own deal and taken that going forwards. So it's about half that are active, currently doing something in real estate, and the other half that are working professionals that are investing passively.
Welcome to the Real Estate Law Podcast. Jason Muth here with Straightforward Short-Term Rentals and Pride Away Stays, and our attorney, broker Rory Gill is here. Rory, you and I have a lot of conversations about different asset classes and ways to make money in today's real estate game, as people call it. I don't know if we've all figured out the solution to that question, with the way interest rates are going these days and inventory, at least on the single family side and some of the multi side. But, we have a guest here today that maybe will help us figure out a different pathway through other asset classes.
Yeah, I mean, if you look back on the last 10 years, everything's changed. We went from the BRRRR being the prototype of the best investment coming out of the recession, followed by like multifamily investing, followed by short-term rental investing. And as anybody out there knows, right now it's tough to come up with a good idea and a good direction to go in this market for quality investments. So I think that now's the time to be a little bit more creative and consider other asset classes that you may have never considered, or that otherwise look soft in the market.
Yeah, and before we hit record, we learned that our guest and his company, Greenleaf Capital Partners, they are investigating office, right? My
Yeah.
goodness, like, who else is investigating office these days? Maybe you'll have to enlighten us on what's going on. But this is Dave Codrea. Codrea? How did I say your
Yep.
name? Codrea. Dave lives in Atlanta or outside Atlanta, and he's from Pennsylvania originally. And he has been a real estate investor for many, many years, over 20 years. He is a co-founder and partner of Greenleaf Capital Partners. Dave, welcome to the podcast.
Yeah, thanks, guys. Excited to be here and kind of talk about what current trends are and what we're seeing.
Man, I want to jump right into this office thing that you kind of threw at us early on, because all we're seeing in Boston is just the demise of office space downtown. It's just sitting there. And Rory, did you see that the mayor somebody just passed the state house? Was it yesterday or today? We're recording this in June. About was it tax rates for commercial space?
Yeah, the mayor, in what I believe to be kind of a misguided plan, has decided now would be a good time to increase the commercial tax rate against commercial properties above what is allowed by state law. And the city council passed her proposal. Fortunately for commercial property owners, since this proposal went beyond what is allowed in state law, it has to be considered by the state legislature, and the state legislature has a history of not considering these municipal home rule petitions. So it looks like this proposal is doomed, but the city council and the mayor supported it. I don't know why they think this would be a great time to increase the commercial property tax rate.
Mm-hmm. Yeah, Dave's smiling already.
That's certainly a tricky position. Property taxes is Atlanta and the South. Property taxes have gone up significantly over the past 5 years. I mean, I don't think that's a trend that's going to be reversing.
Yeah.
It's a stagnant, kind of locked in place that you can get some tax revenue from in going to properties.
Yeah, it's very different from just a couple of years ago. I mean, we've talked on this podcast about a small office space that we owned. We just sold earlier this year, but we bought it right before COVID, not knowing COVID was going to hit. We're grateful that we got out. We made some money on the property as well, and it served us really well while we had it. This is not by any means a massive, massive building downtown, but it certainly was a commercial space. And my experience with financing and refinancing and getting a buyer was very different from, the single family space that we kind of operate in. So, Dave, I want to talk about asset classes, but, first of all, tell us about Greenleaf Capital Partners. How did you found the company? What do you guys focus on? And then we'll get into that office conversation that we just started.
Yeah, I mean, we're based out of Atlanta. We're real estate investors. We're looking for, everyone kind of, you talk about the birth stuff, like looking for value add opportunities, but we're predominantly a shop that's identifying problems in real estate and looking to solve those. If we can refinance out, that sounds fantastic. But for the most part, we're looking for problem assets that we can solve. And we've done everything from student housing to mobile homes. We've done a good number of apartments that there were some rough spots in all of those asset classes where they weren't necessarily the most attractive investments. And there wasn't like a flood of people interested in them at various times over the past 15 years. Now we've taken that and we're looking mostly at commercial space that is vacant or has challenges. And it's like, what is someone going to use that space for? That's really where we're looking at right now, because, in the commercial side, there's definitely fewer operators, right? There's fewer buyers, there's fewer sellers on the commercial side.
Mm-hmm.
But there's some significant entrenched issues in that space that can be worked on. And me and my firm, that's really where we've created value over the past really 20 years. And we see that as an opportunity right now in the commercial space. Predominantly that's vacant. There's a lot of like very high end Class A space that's occupied, has fantastic rents with big companies in there that are performing very well. We're not looking at that stuff. That's a different world.
So if you're targeting these commercial properties that have vacancy issues, where people don't know quite what to do with it, is it because you have a better imagination about what the space could be, that makes you a better owner, operator, and investor in these properties?
Going into it, it's a lot of the stuff has been owned for a long time, and there is a preset capital stack that's already there with a business plan that was put in motion years ago. And it's hard to like move that ship essentially. And it's really hard if you're in a deal 4, 5, 6 years and now you're going to recapitalize it and take it a different direction. That's hard to do just typically with any operating agreement that's out there. That's a hard thing to get through with an investment partnership. All of our commercial deals, and we have investors in all of them. So it's a little bit of us bringing a different capital stack to the equation that can fit the needs of today. And right now, that's a lot of tenant improvements. That's a lot of move-in specs that have to be done to get a deal to the finish line. So a lot of that comes on the leasing cost. Mm-hmm. So that's different if you weren't capitalized for that, or if your leasing stuff changed. It's hard to do that. You look at some of these big box spaces where you have a 50,000 square foot tenant that moves out. That's not something you just call up a buddy and you have a replacement tenant that just swoops in and saves the day there. You got to go do some work. And most of the stuff we're doing is taking bigger spaces and dividing them into smaller spaces that are more manageable and more going from you could look at that as from like you've got a big retail store that leaves, and we're putting in a lot of small service oriented stores that are not necessarily customers coming to that location, but a local business that's providing a service out of that space, and they're going out into the community to execute their business plan. So it's a totally different tenant swap that's happening there. So it's a little bit of a different creative use, but a different capital stack that's doing it, and a different organizational structure of the investment to get that done.
There have been a lot of proposals to go and take, large office buildings or large retail spaces and convert them into residential, because obviously there's a high demand on residential space right now, and it seems like an obvious solution. But not a lot of these properties are built or easily convertible into residential use. And I imagine that's true for the large big box stores as well. Aside from residential, what are some of the ascendant uses out there? What kind of businesses or tenants are looking for space right now? This is going to hopefully give us some insight into what can be done with these properties that are underperforming.
Yeah, we've had a good variety of tenants that are coming into the mix and doing stuff. Everything from athletic training centers, which there's a big, especially in the varying climates we have in this country, right? Like in the South, like it's pretty hot in the summer. So some indoor training facilities have pretty good demand. And, in the North, it's probably the same, but just the opposite in the winter. It's cold. So it's like, hey, an indoor training facility would be nice. And if you have a big box location that has high clear heights and that can work, that's something that goes in there. And there are, and it's not just mom and pop gyms. We just did a facility with a group. They've got about 100 locations. So they're not small by any means. And that's a good lease for us. It's a good tenant that's taking a big chunk of space. We've also done everything from like medical tenants that are going into these locations where you have really a clear spot that they can go build something out. That's been good. The growth of medical has still been really strong, and medical tenants that are providing kind of like a not in hospital care, where you have a hospital brand that's then going out and opening all these either imaging centers or PT centers that are more like out in the community away from the core hospital center. We signed a lot of those type tenants that are kind of coming out into more neighborhood type areas. All the space that I'm buying and actively going after right now is more single story suburban. What was office? Imagine like a single story call center kind of out in the suburbs.
Mhm.
And that stuff has all kind of, I don't want to say it's necessarily gone away, but in my market, they've gone away in my market. They might be in other markets right now, but that kind of single story call center thing has dried up a good amount down here in the Atlanta in Southeast market. So we're converting that to those other spaces. Those are two of our biggest users of space right now that we're seeing.
Are those types of buildings in office parks, like traditional industrial office parks?
Yeah, a single story office park where you have a lot of surface parking. So you can kind of get any use that fits in there. It's not elevated parking with a 20-story office building. There's certainly some opportunities in that space. I don't know quite what the solution is on that one though. But
I just assume whenever like a big box store goes out of business that a pickleball court is going in there.
yes.
Yes.
And that's also driven. I mean, there's a lot of municipalities that want those kind of amenities for for their residents, which people are staying a little bit closer to home if they're not commuting as much or not as many days. So there's value in that for them.
I mean, I've actually never played pickleball yet. I probably should. I'm reaching the age I should, but a lot of people play, even younger people. And I've read the stories about how they don't want it. The NIMBYs don't want it in their backyard legitimately because of the sound, right? But there's a lot of back and forth of whatever the ball, makes a sound. So, people have complained about like tennis courts that are now being converted to pickleball courts that are in their backyard where they hear it. But I can imagine that these people that want to play, they want to play in nice climate controlled environments. You bring up a great point about athletic training facilities in the South and the North, right? Who wants to be sweating at 100 something, 10-degree Texas day, outdoors training? And in the Northeast, we have a really short window of great weather here. The rest of it, yeah, let's take it inside, and I never really considered that as an option. You bring up another great idea about medical facilities. I mean, like what you're doing is you and your tenants are rethinking how we all utilize all these buildings. Whereas in the past, you go to the hospital, you suffer through like the hot temperature if you're training outside or the cold temperatures. Pickleball didn't exist. Like
Right.
this is how the world evolves.
And if you look at deal structure, there's certain points where these things can work. And right now we still have really high construction costs. So going and doing anything is going to cost a lot of money. And these kind of single story office stuff is pretty cheap right now. So you've got a large gap between those costings there. And even if you've got an organization that has a lot of money, like a hospital system, that doesn't necessarily mean they would just want to spend it for no reason.
Mm-hmm.
They're willing to be more creative and look at, hey, I could use this space and it's going to be a fraction of the cost and be able to be delivered in a fraction of the time to get in there and start using it. So you've got a cost benefit and a time benefit for tenants, which is really helpful right now in the market.
And by focusing on what's already built, you're not building things from the ground up. You're
Correct.
saving on
We
that cost.
Yeah, we don't build anything kind of as a investing principle. We are only using existing space. So
Now, why don't the sellers have the same vision that you do? That's probably a terrible question to ask because you have no idea
oh
what's in their
well,
head, but
I mean a lot of them have predetermined business plans that this just doesn't align with. So especially larger institutional owners that they may say, hey, look, we own predominantly office, or we own grocery anchored shopping centers, or we own uh, non-anchored specialty retail. Like there's a lot of different groups. They own 4, 5, 600 of these communities all over the country. And when something falls out of that investment criteria, it's just not something they're not going to all of a sudden get creative and start doing something totally different than their business plan.
mm-hmm.
So we've seen some of that.
What were you when you founded the company or years ago? You've worked in a lot of different asset classes. What were you doing then that you're no longer doing? Are there certain categories that you just have moved on from?
Yeah, mostly what we've moved on from acquiring multifamily. So we haven't acquired any multifamily in a few years right now. Simply the pricing and the return components have been challenging for us, so we haven't done that one. We also haven't bought any mobile homes recently, so we haven't bought any of those communities. So yeah, some of those that was our bread and butter when we started moving to the Southeast. But there was a lot of challenges in the Southeast in the apartment market, 15 years ago. That has definitely been baked out of the game right now. That's for sure.
Do you guys think that you are alone in your strategy and your focus, or are people starting to come along, or are you one of the latecomers into, where you're focusing your investments right now?
Typically when I go out and say, hey, we'd like to look for some office buildings, there's not too many people like, oh, we're doing that too. That sounds like a great idea. But once we kind of go through really what we mean by that, and it's like, hey, we're looking to find a way to reuse single story space that could be used for many things. Like, okay, that makes more sense. We see a few of the repeat players looking at deals down here that are consistent, but there's not a whole lot. There's not a whole lot out there right now on the buy side going after the type of stuff.
What's it like negotiating these deals from the buyer side right now? Because on first glance, I feel like you'd have a ton of opportunity and all the leverages on your side, but what is it like to negotiate one of these deals?
For the most part, it's not distressed sellers. They are institutional, quality owners. They're not actually upside down on deals. It just doesn't align with what their business plan is going forwards. They predominantly do not have a lot of debt. So it's not like there's this big debt burden that they have to pay off. There's none of those like gun to the head type scenarios that we're really seeing. It's more just, hey, they're in a situation where they don't want to put more capital into a deal. The future use of it probably doesn't align with what their original investment strategy is and how they manage their assets. So they're looking to make a change.
Mm-hmm.
So it's not just a free for all of buying opportunity. That's
Okay.
out.
Then how do you find a lot of these transactions and a lot of these deals?
Yeah, it's all through broker relationships, but there's, office brokers that are out there. That's a group of people that are hustling right now. They are out there, they're turning over every rock. It's like 8, 9 years ago when you were looking for single family flips and we were looking for that kind of stuff. Like you're looking for everything and you can find it. And office brokers out there right now are being very creative. They are looking for any option they can of how do they move something and get a transaction done.
Are they successful? I mean, are they finding more people like you to buy these properties?
I would say yes. I mean, the brokers we're working with are extremely active in the market right now. So
Mm-hmm.
I think they're making it happen. That's for sure. It's not easy though. It's not easy right now. That's for sure.
How does the average person who might be listening to this, who is working in some job that maybe they like or they don't like, how do they get involved in this type of investment?
I mean, we syndicate our deals, so we are not a institutional fund. We are not anything complicated. We've kept our organizational structure really the same for the past 10 plus years, and it's all individual investors that are pooled and looking to place money in the different asset classes. So, and there's there's similar groups that are doing it in that function we are. So we're not like a publicly traded REIT. We are not a privately traded REIT. It's just deal by deal, and we're investing primarily in Atlanta, but in the Southeast. So a lot of our investors, it's something you can go see and touch and be like, oh, I like that opportunity. I get the business case for that specific deal. So I'd be interested in investing in that deal.
Are your deals mostly tailored toward long-term returns, or are you trying to arbitrage and flip? Like what's the objective of most of your investments?
We like to go into deals knowing that we have a game plan for if we're going to hold this thing for 10 plus years, we want to be able to do that. That doesn't necessarily mean that's the best investment strategy. Typically, we're going only to like a 4 or 5 year period. And at that point, we have a refinance or we have some kind of capital transaction that has to happen. And then we'll decide, look, are we selling this thing or holding this or what are we doing? But that's typically at the 4 to 5 year time frame. We don't have anything that's going in and saying, hey, we're going to hold this for 10 plus years. We have a lot of deals we've owned for 10 plus years, but that necessarily, we really assess that every time we have a capital transaction or a loan that's coming up. Most of our commercial loans we're looking at right now are around 5 years is our term. We're not seeing much out there that's longer than that. So then we build a 5-year business case because we don't know what would happen, post debt on that side of it.
Rory, it's kind of like what we did. We had a 5-year term, or was it 525 amortized over 25 years or something, and it could reset after 5 years. Was that right?
That's pretty common. And then you have the prepayment penalties in a lot of commercial loans for the first 5 years, usually decreasing each year, but that's a pretty typical loan term. So that's why commercial investors tend to refinance every 5 years, whereas residential residential investors kind of vary it depending on what the interest rates are doing.
Yeah, if we could get a situation where we get a longer term loan, we would do that. But everything we have has a prepay. We don't have the yield maintenance. We don't do CMBS backed loans where it's packaged. So we're doing all direct regional and community bank debt. That's really funding all of our acquisitions. But that's all. They all have a prepay. There's always going to be some kind of, at least right now in the market, there's a piece of recourse on each one of those things that's out there. Our leverage is a lot lower. You're 50 to 60% range on leverage.
So you're raising the rest through private investors.
Yep.
Yeah.
And we've done a mix of raising money and then also we've been fortunate that we've had good investment returns for a number of years. So we have a lot of 1031s that we roll into our acquisitions as well. That's been a process we've used for many years. And some of those were on our 3rd or 4th round of them at this point.
Just keep pushing that forward. So what are your minimums to get involved?
It's been the same since we started, which was $25,000. Okay. So it's always been the same amount. It's always been the same individual investors coming in and looking at opportunities and they kind of build their own portfolio. We do probably like 12, 15 deals a year and across kind of the array of asset classes, as long as it's something that we see there's a problem and it's something we can go tackle.
So shifting over into that side of your business and the conversation when you're raising the capital, if it takes $25K to kind of get involved, I'm sure some people put in more than that if they really see a good investment opportunity or have some extra capital. Do you have an email list and you're sending deals out to people and that's how you hear about them? Is it word of mouth? Is it real estate meetups? Like how are you guys raising the money?
We present some on deals. I like getting out there and talking about real estate. So if we could do a meeting, get together and talk about real estate, I love doing that stuff. There's not as much of that happening right now. So typically it's going out through our email distribution. We send all of our deals out. We don't have any like preferred deals that go to some people or not. And when we were talking about this a little bit before too, like we try and just keep it as simple and consistent as possible. Even the different asset classes, our operating agreements have been the same really on what we're doing with them and how the capital flows.
Since you're working with a lot of local people, I'm guessing they're repeat investors too. Like, do you have people that keep putting money into deals?
Yes. Yep.
Yeah. So they're used to your style, right? They're used to like what the paperwork looks like, what the return's going to be. Do people care about who the other investors are? Meaning not you guys, but like if I want to throw money in, Rory wants to throw money in, and 50 other people want to throw money in, do each of us care who the other people are? Like, is there any community element to this?
There is, and I believe they should care, because you want to make sure you have, other investors that have at least the same uh, future vision and idea of what you're trying to do with your capital. I think you want to make sure you have alignment in there. We try and do that just through just different video calls that we're doing with the investor group and live Q&As to make sure we're answering any kind of questions that are out there. But I think if you put people into a deal and they're not aligned with kind of where it's going, I think it could lead to some problems, certainly down the road. That's also one why we like to keep our minimum lower, because we don't want people going into a deal in like kind of putting all their eggs in one basket.
Yeah.
And we also don't really have we don't have large investors that are coming in and taking up 80% of the capital stack and saying, hey, this is how this deal is going to go now. There's also that risk. So there's got to be a balance of like-minded people that are in a deal together.
You don't want to have one voice that's too loud.
Right. Yeah.
But then you also don't want to have too many voices.
Sometimes we get a lot from that, right? Our investor Q&A that we do, we do investor Q&As on our deals, and we do them at the end of each quarter. We get a lot of good questions and insight into what people are seeing in their markets. And it's like, hey, we're seeing this here. How does that impact the deal that I'm invested in Greenville, South Carolina? It's like, well, hey, this is the market in Greenville, South Carolina is a lot different. Here's what we're seeing there. So I think it's helpful when we get more input from all of our investors each quarter. I'd say if I could get more questions from my investors each quarter, that would be great.
Mm-hmm.
Always kind of like we get a good amount, but I'd like more, because it really just gives us an idea of what's happening in all the different markets.
Did you say that you work on, do you have funds as well, or are you really doing it deal by deal?
Yeah, it's just deal by deal. We have, everything has to stand on its own and perform on its own, and it's distributed to investors on its own. So some of our investors have been with us for a while. At the end, if they've been with us for 10, 12 years, they're in a number of different deals. So they get a number of different distribution checks each quarter.
Mm-hmm.
So as versus a fund where, you might only be getting, you're getting one check on your
when people invest, do they start getting checks immediately, like within the first couple quarters, or is there a holding period where they wait and then eventually they're going to start getting paid back?
Yeah, it's varies tremendously deal by deal. Some of our deals, if we're buying it vacant and doing a full renovation, putting in a new tenant there, that one might be 2 years before it makes a distribution.
Mm-hmm.
Whereas others we're buying and, they're occupied now, but we're like, hey, we can get a better tenant that's going to pay significantly more rent. So, hey, it's going to be vacant in 2.5 years. So we'll have distributions now, and then we won't in a little bit. So they all have a very different business plan associated with each deal.
Talk about the type of investors that throw money into the deals that you're working on. We've heard a little bit about what your strategy is to make them money, but who are these people?
Yeah. But we've got you look at it like two categories. We've got people that are they're obviously interested in real estate and they want to generate passive income, but they're not an active real estate professional. They're typically a professional outside of real estate that's working and then taking earned dollars and putting it into passive income. And then we have the other segment that's active real estate folks that normally have their own investments as well. So they're doing their own investments. They're actively buying and selling stuff, and then they can kind of use more of the active depreciation that's coming out of our deals that they're receiving on their investment side. So it's really those two types of people. We've got a lot of individuals too that have either sold deals or rolled 1031s, and instead of being that active owner operator, they've rolled into our deals. And then we've also had them where they've rolled out and they've bought their own deal and taken that going forwards. So it's about half that are active, currently doing something in real estate, and the other half that are working professionals that are investing passively.
So one can sell a property that they own personally and 1031 exchange that into one of your deals?
Correct. Yeah. So we've done tenant in common structures where you basically have two LLCs that are buying a deal together, right? And then sharing in the economics of it. So we've had people that had a 1031 or they had a family asset that they sold and they used a 1031 and we put that into different, various pieces of our deals over the years. And then sometimes that 1031, we sell that deal and they'll keep their 1031 and go buy something else with it.
That is
So,
super interesting. I had no idea you could do that.
so that's been a good process for us over the years in a great way to, obviously the 1031 is deferring capital gains. So people are normally a fan of that one, especially when they've owned once you've started owning deals for 10, 15 years, some of those 1031s that invested in us have been active for like 20 years. So that entity is going to roll forwards for a long time.
You also mentioned depreciation though. So there's another tax benefit by getting involved. If you have some people that have their own investments separate
Yeah,
from
sure.
your investments, there's a way that they could somehow recoup some depreciation from throwing money into one of your deals.
Correct. Yeah. If you're getting a K1 out of a real estate deal and you're an active real estate professional, which I think is over 500 hours a year, and you already have, passive income that matches that with your real estate investments, our tax treatment flows through to those investors as well. So that works well for them because they've got, then I think part of the problem with investing in real estate is you start doing it passively and then it becomes very active.
Mm-hmm.
You look back 10 years later, you're like, wait a minute, where did the passive part of this go? It's now it seems like I'm actually doing a lot of work. So we got a lot of people that kind of happens to over the years.
What's the most surprising type of tenant that you guys blended?
We have about 550 active tenants right now. So there's some that are off the wall ways of making money. And some of them, we have ones that are like recycling electronics, which is like, okay. They seem to be doing really well. We have people that are like literally breaking down pallets and reassembling them. And the amount of throughput, like you want to see a place that's, man, that thing is cranking. They're literally taking apart pallets and reassembling them and then shipping them out. And they have an endless amount of stuff going in and out every day. So that stuff's pretty interesting to see. But we just signed a lease with a race car simulation company, which is really neat. So you think 4 race car simulators like facing each other in a like a 4-person pie chart, basically.
Mm-hmm.
So you're all in just like wrap around screens in front of you. So it's really neat. We have another group that does that builds in-home golf course simulators. So really cool to go in there and just see. They have all their like specs of what they do. But then they kind of use that as like a mini showroom, and they take all their deliveries there, kind of build their specs and models, and they go in and building that at either corporate locations or people's homes. So there's tons of different stuff people are doing. So it keeps it interesting. You always get to go see, what is this person doing?
Mm-hmm. I mean, you guys also, as the landlords, if you're owner of the building, you have to kind of make sure that they're financially stable and can pay their lease and their business model makes sense, right?
Yeah. So we most of the commercial leases, there is a component of that where they're sharing what their financials are, and they're underwriting stuff, and they're signing either corporate or personal guarantees associated with that lease most of the time. And that's all through NDAs that information is shared. And, there's a lot of businesses out there that are doing phenomenally well, which is exciting to see. And I'm genuinely just like a curious person. So I love seeing how these businesses are working and what they're doing. But that's kind of going down the rabbit hole sometimes of like interest in a specific tenant.
Yeah, sometimes people can get so wrapped up in the news cycle or their everyday, the world that we all see. And if we all think that people aren't going out of their houses and everyone's still working remotely, and maybe some people are getting called back to offices, but urban downtowns are not thriving, across the board as they were, so you might start to hear that commercial assets are, depressed and everyone is a, distressed seller. And then someone like you comes along and you're telling us kind of the opposite with a component of this marketplace where these are not distressed sellers. These are places that, just need a different owner, to kind of fit in a different business model from the people that are selling it. And then you go find all these thriving new businesses that need spaces like this. This is such an interesting different take on what you would see on the news?
Yeah, we are actively signing a lot of leases on a weekly basis. We have just over, we have like 2.3 million square feet. And typically we have smaller tenants. We're taking a bigger space and putting in a smaller one. So we're going to have more tenants than average, but we sign a handful of leases every week.
Mm-hmm.
So, you know, things are moving and businesses are opening and doing stuff in the world that I'm operating in, at least.
Rory, any final thoughts for Dave before we get to our last few questions?
Well, I was going to ask about vetting the commercial tenants, but I'm glad we got there. But I'm glad we're ending on kind of this optimistic note about the possibility of investing and also just the goings-ons of the economy in general. So let's end it there on the optimistic note.
We have this really resilient economy. We just do, like, I don't know. I'm not an economist, right? But, consumer optimism seems to be out there. Things are more expensive. Loans are more expensive, but people just keep chugging along, living their lives. And, we all have a finite amount of years on this planet. We want to optimize those. We're not going to just sit back and, not enjoy what we're doing and not try to grow. So maybe that's why the economic engine of the United States keeps pushing along.
I think you look at, like, there's obviously better times to start businesses, but it's also better to do it now than later.
Oh yeah. The best time to start business is always today, like regardless of what day it was.
So we have a lot of people that are opening franchise type locations as well. We've seen a lot of growth in that area where owners are coming in and growing something and they're doing pretty well. Their numbers look good.
Yeah. They're paying their rent, so you're happy.
Yeah. Yep.
Let's ask our final couple questions we ask of all of our guests on the podcast, just to wrap up the interview and get to know you a little bit better. First question: if you can get on stage for half an hour and talk about any subject in the world with zero preparation, what would that be?
Just not giving up. It's like, I mean, you can do that if you're just up on stage for half an hour, just don't quit. But there's a lot to say of just not giving up at what you're trying to do and not necessarily listening to all the people that say you're either not going to be able to do it or it's not going to work or any of that shenanigans. It's like, just not giving up, I think, is a huge skill or a huge trait or a huge quality that people should have.
Well, that might dovetail into question number 2, which is, tell us something that happened early in your life or career that impacts the way you're working today.
One of my best remembrances, I guess, was, I was starting with my business partner. We were replumbing a building, which I don't know why we thought this was a great idea for us to be doing, but we did it. And we would spend hours doing crap. And then we would hire a plumber to have them come in and be like, you guys have no idea what you're doing. This only should take you like 10 minutes. And they'd show us the shortcut to do it. And it's like, we just spent 4 hours trying to figure that out. So asking for help is sometimes a very hard lesson to do, but it can be one of the most valuable things you do as well.
I wonder if you would have continued that project if you knew that it was going to take 4 hours. I mean, that's the curious part about all this. I mean, like, you're probably pinching pennies back then, so you're like,
I'm still pretty thick-headed, so I probably would have just done it anyways.
Yeah.
And I do that even now. Even people on my team are like, Dave, why are you sometimes just grinding away at stuff? But I also enjoy doing that. And I think that's also how you learn and respect, like, what that question, the value of that question is, getting some hands-on experience.
I also think it's important for us to do what we want to do. And if there is a lower value task that people like to do, one would argue that maybe you shouldn't do it if it's because you don't want to do the higher value task. But secondly, if you want to do it, do it. If people like to cut the lawn, cut your lawn, right? Don't hire it out.
Yeah, exactly. Yeah.
Final question. Tell us something you're listening to or watching or reading these days.
I've been listening to the All In podcast. That's one thing I've been listening to. And then books that I'm reading right now. I've got an 11-year-old girl, so she's going into 6th grade. So I'm reading a book on how to be a better father to your basically middle school daughter, which I've heard is going to be all the exciting years. So that's probably the one that I'm like, how do I do that over the next 3 years and not mess that one up? So
exciting, like sarcastic, exciting, like lots of weird things that are about to happen. Yes.
It's like, I've heard from, other buddies that have, and I've got one friend, he's got 3 daughters and the youngest is in 10th grade. And he's like, you better get ready to just do a lot of listening. lots and lots of listening. Like, okay. He's like, schedule that time so you have it with your daughter to do lots of listening. You won't be able to fix everything, but you got to be there to listen. So it's like, okay, it's good advice.
We have a 5-year-old daughter, so we're in those years.
Yeah.
They're good years. I'm told these are the fun ones coming up, but then, things change. All right, awesome. Well, hey, I appreciate all of your insights, Dave, on how you guys have been operating and what you've been focusing on asset class wise. How you find investors. Like the syndication world and people that are investing at a really high level, like you guys. It's so fascinating to us as to how you built it and how you guys operate. So thanks for giving us a little bit of a peek behind the curtain of Greenleaf Capital Partners. If people want to get a hold of you or learn more about your investments or invest with you, what are the best ways they can do that?
Yeah, best way is really either reaching out through LinkedIn or on my website. And then we've got our end of quarter Q&A each quarter that it's kind of open and we go through any kind of questions that are out there on the real estate side.
Cool.
Yeah.
Put that in the show notes. And if you are interested, please reach out to Dave. He's very easy to get a hold of. Rory, where can people get a hold of you?
You can find me at rorygill.com, RORYGILL.com. I know I just spelled it out. Or you can check me out at my law practice, Urban Village Legal, urbanvillagelegal.com.
Rory, we're like almost 200 episodes in and you're spelling your name out in this
And that's the
podcast.
first
Like,
time I've
come
done
on.
that too. I don't know what happened where I just completely fell off the instructions, but I decided after 200 episodes that it was time to spell it out.
Remember that time before we hit record that I'm like, you don't have to spell out any of your letters or your website, Dave. Like, we'll put it all in the show notes, link it up right there. And sure enough, you're the one that violates the rules. That's okay. That's okay. If you want to be a guest on the podcast, please reach out to us at realestate.podcast.com. We record throughout the year at various times. So if you catch us on one of the times we're recording, we'll get you scheduled. If not, we'll push you into the next time that we're recording. If you've enjoyed this episode, we love 5-star reviews on iTunes, Spotify, anywhere else you're listening to this. We read your comments on YouTube, and we hope you've learned something from this episode because we certainly have. Dave, thank you so much for your time today. This has been a pleasure getting to know you and seeing how you guys are operating. We really appreciate all your time on the podcast.
Yeah. Thanks, guys. It was great talking.
Thank you. And thank you for listening. We'll see you next time.